He is one of the innovation leaders at Deloitte and the author of Deloitte Thought Leadership on Corporate Venturing called The Next $1 Billion Idea. He is a mentor to startups at the London Business School Incubator and works closely with HSH Prince Albert II of Monaco's Clean Equity Initiative. He has been quoted in publications such as the Financial Times, the Wall Street Journal, The Economist, the New York Times, and his research on corporate cash received front-page coverage at Davos. He's a frequent commentator on Bloomberg, CNBC, and BBC. Please welcome to the stage, Mr. Sriram Prakash.
Thank you. I didn't know which was more hot, the reception or the weather outside. So, hello all. One of the best things about an afternoon slot is that one gets to entertain the audience because everyone's sleepy. So, I don't have much talent, so I'm going to tell a story. I'm from India originally, from a city called Chennai. Has anyone been to Chennai? I can see few, not that many. Well, Chennai is the 4th largest city in India. It's got a population of about 7 million, which I believe is the entire population of Bulgaria. So I'm originally from Chennai, and this is about a student who is also from Chennai. So years ago, about 10 years ago, there was a student called Arun Ganesh. So he came from abroad, and he went to Chennai to study engineering. And as students do, he wanted to use the bus to save money. And what he found out was that, none of the buses, the route maps were so outdated. In fact, some of the route maps were published in 1950s, and they were still not updated. So being an ingenious young chap, what he did was he said, okay, why don't I get my fellow students to everyone starts making a map of different bus routes, and then, before you know, we'll have the most updated bus routes. Today, we call it as crowdsourcing, but he started this something like a pet project about 10 years ago. And within a week, believe it or not, within a week, he was able to get his fellow students to map out the entire Chennai bus route map, which has over 400 routes, distinct routes. And then what he did was, as a student, he used it for a student project, and he uploaded it in something called the Openstreetmap Project. Has anyone heard of the Openstreetmap Project? Quite a few. The OSM, of course, is a free map source. It has been around for quite a while. And this is how it looks like. This is a typical map from OpenStreetSource Mapping Project. And just to give you a comparison, this is what a Google map looks like for exactly the same place. OSM is crowdsourced, it's more dynamic. In many ways, it's more accurate. So around the same time when this whole project was also happening, there were a bunch of young people in a very far away city in Tel Aviv. They also thought, hey, this is a cool idea. Why don't we also do something like that? Why don't we crowdsource information about traffic? Why don't we crowdsource information about where the signals are coming from and so forth? You probably know where I'm heading. They very quickly built a company around it. It was called Waze. And Waze was sold for $1 billion to Google. I think it's not just a tale of two cities. It's also a tale of two different ethos. It's a tale of two different ways to look into innovation. Because one thing is for sure, it doesn't really matter where. Innovation can come from anywhere. It can come from a bus depot in Chennai. It can come from somewhere in Sofia. It can come from Shanghai. It can come from anywhere. But the real deal is if you want to turn your innovation into $1 billion, you need a very different set of rules. You need an ecosystem. You need entrepreneurs. You need the corporates. You need policymakers. You need government. And there are very few cities and very few ecosystems in the world which can allow you to do that. But the big difference today is that just because there are very few ecosystems in the world, it doesn't mean your ideas can't travel. We are in a digitized world. Ideas have no boundaries anymore. Ideas can come from anywhere. That's why it's really important. I was particularly pleased that I was able to come to Sofia for the first time and get a sense of the buzz around this place. There are so many brilliant ideas. But then, how do you take these ideas and turn them into $1 billion? Well, before that, why don't I talk a bit about why is it so irrelevant? Why are corporates so interested in turning these into $1 billion. I think what's happening today is we are living in a so-called economy of expectation. That's what I like to call it. Many of us know this figure. The corporate cash reserves globally is about, of the 1,000 largest non-financial companies, is about 3.1 trillion. I mean, of which Apple itself has around nearly 250 billion worth of cash sitting on its book. Just think about that, 250 billion worth of cash. And here's another statistic which not many are aware of. Of this 3.1 trillion, this is the total cash reserve of the 1,000 largest companies in the world, 80% of that is with 20% of the companies. We talk a lot about innovation, we talk a lot about investment, but what do you do when 80% of the cash which is there to invest is in the hands of 20% of the companies? At the same time, what's also happening is this. It's a pretty interesting chart, and a lot of my clients love it. What the blue line shows is the S&P 1200 index. It's a composite of the performances of various indexes like S&P 500, FTSE, and so forth. It's been record high again and again for the last few years. But look at the green line. That's the revenue growth rate. That's a revenue growth rate of the companies which are forming this index. The revenue growth rate for the last 3 years has been on the decline, but the share price has been on the high. This is certainly not sustainable. Sooner than later, analysts are going to demand growth. They want revenue growth, and where does revenue growth come from? Markets are getting saturated. There's backlash against globalization. Markets are full of uncertainty today. So innovation has become such a strong prerogative for companies to grow. But then, companies are also facing a very interesting quandary. So you have the company here, but innovation very much is happening in the ecosystem. Not just the ecosystem as we know, as I was saying previously using the example, ideas are coming from everywhere. How do you, as a company, tap into those ideas? And if you're a startup somewhere in some corner with a brilliant idea, how do you make sure that your ideas indeed realize to the same means? One of the things which has happened over the last couple of years is that companies are increasingly, they are aware of this problem, and they have been using various means, like particularly mergers and acquisitions, to tap into innovation. Rather than try to focus purely growing organically, they're using inorganic means. Just look at this chart. Just about 5 years ago, the total spend on innovation-led M&A, by which I mean trying to buy things like digital, analytics, AI, robotics, those categories, it was about 72 billion globally. Last year, it was 300 billion. This is one of the fastest growing areas in terms of M&A markets. And especially with the M&A markets, with the markets getting very choppy in 2017 with uncertainty, this shows no sign of strain. And there's another reason why this is happening. For those of you who remember the dot-com era, the nirvana for a lot of startups was an IPO. But how many IPOs have happened over the last 2 years? You can count the number of IPOs. The reason is, of course, cheap cash, cheap interest rates. All of that has allowed a surge of yield and the companies, and it is very easy to get investments. So it is just money recirculating again. With the lack of IPO, companies are just buying them up. This is the exit source for majority of the startups. It's not just about exits. If you look into corporate, they're also extremely active in venturing. I think the granddaddy of all venture funds, the SoftBank 100 billion venture fund, was launched last year. I was at the Mobile World Congress earlier this year. I was speaking there, and the headline act was Miyazaki-san of SoftBank. And it was a tremendous speech, but he also said something really interesting. He said that this fund is not just about, trying to invest in more companies and trying to create more Uber. He was asking about how do we look into it from a very different way. What do people want? That's what we're trying to invest. This is one of the groundbreaking funds which I have come across. So companies are dead serious about this, and for the startups out there, you should really be thinking about, in terms of your growth, in terms of your next rounds, and also in terms of your exits, how do you work with corporates early on in your career? And there's another very interesting trend which is driving this particular growth. Look at this chart. Historically, what's always happened is the TMT, the technology, media, and telecom sector. They are the ones who have been investing heavily in these technologies. But look at the green chart. That green chart, that green line is in fact the amount of investments done by non-technology sectors acquiring technology assets. Here we are talking about a healthcare company trying to buy a digital asset, or a retailer trying to buy an AI asset, or a manufacturer trying to buy robotics. That's been growing, and that's one of the primary reasons why this market is flourishing. Because today, if you're a startup, suddenly you have not just one exit, but at least 3 or 4 sectors who might be interested in you. That's totally changed the dynamic. And the sectors, or particularly the segments which are benefiting the most, are these. The 6 segments which we have seen that which get the most investments in terms of venture funds, as well as M&A exits, are robotics, digital and social, fintech, Internet of Things, AI, and big data and cognitive analytics. That's where bulk of the money is headed. I'm not going to go into detail in everything, but let me just point out the traction which is happening across 2 different areas. Let's take something like digital and social, for example. That's the one right on top in the middle. The light green chart shows the amount of M&A investments, and the dark green shows the corporate venture investments. That's a fine balance. That's a classic sign of maturity. Fintech, same thing. This has been around for the last few years. Companies are more comfortable, the valuations are coming down, which means that you're able to have a finer balance in terms of venturing versus M&A. But take a look at Internet of Things. That's the bubble here in the corner. Last year alone, nearly 80 billion worth of deals were done in IoT. Now, I must admit, some of these deals were very, very large and they tipped the balance. But what that number also tells you is that IoT is finally coming into a stage where the commercial potential can be realized. Companies are making very, very big bets on the future of IoT. So that's something to watch out for as well. And look at AI right next to it. AI is almost getting as much of venture investment as much as it's getting in terms of exits. That's another interesting sign in terms of everyone is trying to dabble because it's such a vast area. They're trying to get a sense of what's happening. Then all this begs the question, yes, there are 300 billion worth of deals, yes, there are lots of venture funds, but where is this all leading? And if you're a corporate, how do you think about this glut of startups which you come across? Because the most frequent question which we get asked is, okay, I see 3 startups today, all of them are saying their technology is the best, how do I differentiate? My technical team says one thing, my marketing team says something else, my CEO wants me to do something totally different. So how do you differentiate? But to me, it's almost like asking the wrong question here, because partly what we ought to be looking into in terms of the supply and demand equation is, what are the future of the industries? Where is it headed on? Let me give you an example. Let's take mobility. We heard a lot about mobility over the last day. Let's just look what's happening. The future of mobility is not necessarily being defined by a car manufacturer saying we are going to build autonomous cars, but it is creating its own ecosystem of so many deals. I'll just give you a couple of examples. One of my favorite ones is, of course, the big ones, GM, Ford, all of them have made very big bets on autonomous cars, on AI. But then what happens when you're sitting in an autonomous car, you're going for a long journey, and you have no one to talk to? That's where deals like this are coming into place. Volvo and Ericsson are teaming up, and they're trying to talk with Netflix to start thinking about how the future of entertainment looks like in autonomous cars. And then look at this. BMW recently invested in Parkmobile around the parking. That's interesting because suddenly it brings the whole finance equation into the play. And a lot of these companies are now trying to get into fintech, into payments and mobile payments in order to get more attractive to their ultimate buyers and investors in the automotive sectors. Look at what's happening in terms of the investment GM made in Lyft. They're all taking bets. We don't really know where autonomous car is going to go. Is it self-driving, or is it going to drive a totally different model where people will prefer to not own the cars, instead have totally a mass leasing model? Manufacturing, same thing. Manufacturing, I think one of the most interesting deals I've seen across is Airbus Ventures recently invested in a company called Local Motors. Has anyone heard of Local Motors? There you go. I'm sure my friends from US would have heard. I think Local Motors is a fascinating company which is trying to bring the crowdsourcing model into manufacturing, which is quite an audacious task in itself. But they are trying to do two things. One is, the claim to fame so far is that they were among they have printed the first fully automatic 3D printed car. And the way they do it is by using 3D technologies and other things, but at the same time, the fundamental design, the technology is crowdsourced. It's crowdsourced not just from a vast range of engineers and software, but also from the standard, the large corporates like IBMs of the world, the Samsungs of the world, and so forth. So that's bringing a whole new dynamic to what the future of manufacturing could look like. Harry's. Harry's is an interesting company. Their closest rival, Dollar Shave Club, just had a very successful billion-dollar exit. But look what Harry's is doing. This is the first time I've at least come across where you have an innovative startup, an online company which fundamentally focuses on marketing, going and buying Fintechnik, which is a very old manufacturing company in Germany, because they want to fully integrate and have control over the supply chain. So you have startups buying old-style companies, not just old-style companies trying to go into digital. Future of consumers. That's where the big battle is being fought. This is not just about consumer industry, but it's a future of consumer. One of my favorite examples, take Disney. Disney recently took an investment in Sphero. Sphero is a very interesting company. They are into augmented reality, where they are trying to have immersive technologies similar to Pokemon Go across all sorts of toys. Just think about it. Your next visit to Disneyland, how that could be a very different event when you have a much more augmented reality type events around Disney World. The other very interesting one for me is British Gas, one of the largest utilities companies in the UK. They recently bought AlertMe. The reason? Because Google bought Nest, and suddenly every energy company in the world woke up to the reality there is something called IoT. So they are trying to get closer to consumers, whereas the biggest fight in the past was how do you lobby the government in terms of getting a fair price. And there are so many other such examples. I want to tell you about the future of health. Again, extraordinarily promising area. If you're a startup, suddenly you'll have about 4 or 5 different sort of exits for you. Look at what's happening in the sportswear sector. Companies like Under Armour, Adidas, they are trying to buy into startups which have access to social communities, access to, are able to infuse IoT, et cetera, into their sportswear manufacture. Look into what's happening with BAM Labs. BAM Labs, again, it's a very interesting company. They are trying to embed IoT and health-related monitoring devices into your bed. Any doctor will tell you the best way to measure your heart rate and other bodily function is when the body is rested. And when you're most rested? Usually in an afternoon conference when everyone's sleepy, or when you're sleeping in the night. So Select Comfort, which is the largest mattress company in the US, they recently acquired BAM Labs. So the point here is, or look at probably the most interesting and the game-changing one is going to be when finance starts meeting healthcare. So AXA, one of the largest insurance companies, took an investment stake in BioBeats, which is into IoT and healthcare devices. What's happening here is that there is, for the first time, genuine convergence between non-traditional sectors all converging around a particular opportunity like health or manufacture, consumer, and so forth. But the most, I think the one with the most potential probably is, again, finance. Here's an open question for you every time anyone tries to pitch you a fintech company. If you take something like payments, what's the payments industry all about? Is it a banking thing? Is it a mobile thing? Is it a retailer's game? Everyone is having a vested interest in payments. And everyone looks into these opportunities in a very different way. They have different expectations of valuations. They have different expectations of what they want to do with it, how they want to integrate. So the opportunity, again, where I would like to provoke both corporates and startups here is, if you're a startup, your exit options have suddenly opened up. Not just the exit, but also your investment opportunities. But you have to think about where are you adding value and what are you disrupting and which sector are you disrupting. It doesn't matter what technology you're following. If you're a corporate, it's a very different question. If you're a corporate, you need to start thinking about what's the business I am in and what's it going to be in 5 years' time. Ultimately, it all boils down to choices. So from a corporate perspective, you need to make choices about the trajectories of growth. What are you going to do? What business are you going to be in 5 years? And if that's the business you're going to be in 5 years' time or 10 years' time, what are the shifts happening around you? What are the shifts happening in technology? It's not just sufficient to say I'm interested in digital or marketing or AI, but what are the underlying shifts which are propelling those areas? And what are those shifts? How are you responding to those shifts? Otherwise, any such acquisition is just going to not do you any good. What about the shifts in consumer behavior? That's something which is much more unappreciated and hardly thought about. But consumer behavior is driving a whole new set of models. Models like peers over corporate, use different pricing models for usage, rather than having full-time products, turning products into platforms. So how are you going to tap into the shifts in consumer behavior, and how does that help in your trajectory? And finally, you need to start thinking about the convergence, not just looking into your own sector, but also trying to see what's happening across other sectors. How are they converging, and who's going to be eating your lunch? At the moment, every time everyone seems to have an answer is that, well, Google is going to come. Well, Google is just one among many. There are so many other companies. Everyone is thinking about how do we try to make the most of what our market is, how do we try to get into the adjacencies. And that's causing this convergence. And then it's a very straightforward decision. Do you invest? Do you buy? Or more importantly, do you collaborate? Deloitte, of course, we ourselves are not immune to disruption. Deloitte is a very old company. There are 4 parts to Deloitte. We are into audit, consulting, tax, and M&A, which is where I am. But all of these areas are getting disrupted. Take something like audit. Hardly. Audit has been unchanged for 100 years, but a combination of regulatory and web bots and so forth can fundamentally change audit. Why do you need auditors? So much the way we are also reflecting about a lot of these things which I just talked about, but equally we are working with lots of our clients to take them on a similar journey. Because this is not, no one's going to be immune to these shifts. No one's going to be immune to the convergence. These have all gained significant momentum. So if you're a corporate, you need to think about your strategic choices. If you're a startup, you need to think about how do you work with corporate to maximize your options. Hopefully those were some thought-provoking ideas. I'm going to be around here for the rest of the day, and thank you for your time.